All right, welcome back to the Midweek Update. My name is Patrick Denawilla. I am the editor of the Chart Report. Joining me today is Steve Straza of All Star Charts. Steve, how are you today?
Doing all right. How's it going over there?
It's going well. You're looking good.
Yeah, I got the island vibe on today.
You are a regular island boy. Anyway, let's get right into it. We got a lot to cover this week. So let's start off with the Russell 2000. All eyes continue to be on this chart. Continues to bump its head on resistance around that 210 level. So as we know, small caps tend to lead the broader market higher or lower. So seeing small caps get rejected here is no bueno, right? Turning to the S&P 500, it's sporting this kind of bearish head and shoulders top. A lot of people are seeing that pattern, which normally when that many people are seeing a pattern that's that obvious, I kind of get a little skeptical, but there are some other bearish developments going on that are keeping this looking ominous. Right here, we have a chart. This one comes from Steve Sotomayor over at Bank of America. And he's basically highlighting that head and shoulders top, but also that widening out of credit spreads that we've seen over the past few weeks. And Steve, I know you can speak to this one a little bit more clear than I can. So why don't you go ahead and take that away?
I mean, it's a great chart, right? We like to look at it. There you go. We look at it. It's just the inverse. So it's a lot easier at home. If you want to see what credit spreads are doing, you can just chart high yield bonds relative to treasury bonds. And it's going to show you pretty much the same kind of picture as you would see from OAS credit spreads.
What is this? This is HYG versus IEI?
Yeah. So it's just, the most popular high yield bond fund, which is HYG. And then you want to align the durations of the holdings. And that's why we chose IEI instead of IEF or TLT.
That's like 7 to 10 year, right?
I don't want to misspeak. I think it's closer to 4 though.
Okay.
Anyway, I know that, the durations of both those funds are as close as you're going to get it. So that isolates just the credit risk, which is what we're trying to see. So basically new lows for this chart will be the same thing as new highs for credit spreads from the chart before. And yes, it does tend to move very closely. It has a really, high correlation with the stock market. So what Steve is saying here, which is if this bottoming pattern reverses and resolves higher, you're likely to see that head and shoulders top actually be a head and shoulders top in the S&P. And we're just saying we're showing the same thing, but using HYG IEI, right? So if HYG IEI resolves lower from this distribution pattern, doesn't bode well for the stock market.
Yeah. So I know you brought over this Fallen Angels high yield bond chart. I'm not sure what the heck it is. Do you want to introduce that a little bit?
Yeah. So when we look at credit spreads or when we look at the HYG IEI ratio, what's really driving that relative trend right now is high yield bonds, the numerator. They're the higher beta. They're the riskier, between high yield and treasury bonds. They move faster. So right now you're seeing bonds fall. Well, high yield bonds are falling at a faster rate to the downside. That's why we're seeing credit spreads widen. So in order for credit spreads to stop widening and for the HYG IEI ratio chart to not end up, executing this topping formation and resolving lower, we need high yield bonds to find their footing on an absolute basis. And the reason I'm focused on Fallen Angels, all they are is they're high yield bonds that were very recently marked down from investment grade to junk. So they're they're the newest high yield bonds on the street. And what you're seeing here is that they're at a very logical level. You see that former resistance from 2017, 2018, 2020. We're right back at that level right now. So this is a very logical level of potential support. Maybe we do kind of carve out some sort of tradable low here, and that would really save credit spreads and keep them from ending up being, from HYG IEI being that topping formation and executing to the downside.
Yeah. Let's bring our attention back to small caps real quick, back to the Russell 2000. We have this chart here. I mentioned briefly earlier that we keep getting rejected every time we retest that former support there. What are you seeing as far as small caps in the Russell 2000?
I mean, it's a great point, right? And it's really all eyes on the Russell and these former lows right now. So the Russell 2000, which you could see in the middle pane, is retesting its breakdown level from below right now, all those pivot lows from last year. What I'm really watching is the leaders in small caps. Bulls really need to look out if we lose the leaders. The leaders have been value. That's on the top pane. They're still above those pivot lows from last year. So I think you don't want to see that chart also resolve lower, like growth and like the Russell 2000 in the lower panes. So I'm watching that 152-ish level in IWN.
IWN. Got it. So let's take a look at some of the pockets of strength outside of stocks. Emerging markets are actually showing strength relative to US stocks. Right here, you can see emerging markets ETF EEM is up about 1%, while the S&P 500 is down about 8%. So definitely some relative strength there. What are you seeing as far as emerging markets and US and some of the pockets within emerging markets that you like?
So that's a great ratio chart. We're seeing a lot of this right now. When you look at the international diversified indexes and chart them relative to the S&P 500, first of all, if you zoom out on that chart, go back to the ratio chart. If you zoom out on that ratio chart, it's been about 10 years of just straight lower and to the right for this relative trend. So we're finally seeing some sort of reversal or bottoming action, trying to build out a little base here, broke the trend line. We got our first overbought readings in a long time from a number of these ratios, EEM, SPY included, which is what we're looking at.
Which is actually a bullish thing, right?
Yes. So
in your opinion?
RSI 14 hit overbought conditions above 70. That's what we look for. That's a bullish thing. So we're starting to see more and more signs and more evidence of a potential trend reversal on a relative basis. That would make a lot of sense in an environment where value and cyclical stocks are the leaders, because that's what international has a high exposure to. While the US, you mentioned, we're down whatever it is, 8% in the S&P 500 year to date. That's because the S&P 500 is really a growth index. When you go overseas, it's not so much the case. So we brought along a chart that just shows the performance year to date of our international ETF universe. And on top, you're seeing countries like Brazil, Peru, Chile, South Africa. These are all commodity countries, right?
And this is ranked by the strongest year to date, like so far in 2022.
Yeah, so Brazil is your leader year to date. All of these areas have a heavy dose of commodity exposure. When you go down the list, you see the energy countries, Saudi Arabia, Qatar, Colombia. So this is where we're focused right now. This is where international leadership is. And after 10 years of outperformance from the US and from growth, it's a little bit difficult for investors to even envision a world where international outperforms, but it really seems like the seeds have been planted for this trend to really take hold and be sustained.
Yeah, and you're seeing a lot of like Latin American names on the top of that list there, right? And I know you have some Latin American countries that have your eye right now.
Yeah, Brazil's been ripping. You could show that chart next. Peru, Chile, this is all what you're seeing in these charts. This is just classic bottoming action, right? It looks like bearish to bullish trend reversals are underway, not just for these charts on an absolute basis, which is what we're showing here, but the relative trends also. And when you move outside of the international diversified indexes, I know we showed EEM SPY, but when you look at some individual countries relative to the S&P, you're seeing even larger bases start to resolve higher, whether that's the United Kingdom, Canada. There's a lot going on, and it's starting to really look as though the best opportunities are now outside of the US, which is something that hasn't happened. We haven't been able to say for a very long time.
Yeah, I mean, for the longest time, though, China had been the biggest drag on EEM. So what are you kind of seeing there? Because it is such a big portion of EEM.
It still is. But here's the thing. China is whatever it is, 35, 40% of EEM. So when you look at the EEM index, we're still below those key 2018 highs and doesn't look great at all. But that's because China is responsible for a lot of its, a lot of the weakness there. When we look at other individual EM countries that might only be 2, 3, 4% weighting of the EM index, that's where the strength is. So you actually don't want to express this thesis through EEM like you traditionally would. If you do want an international diversified index, it's EMXC, which is all the same components of emerging markets, but it excludes China. So
interesting. I bet that one looks probably a little bit better than just EEM on its own, right?
Yeah, it's held those 2018 highs, similar to other international indexes like the All Country World Index, XUS, which is VEU, or EFA, Europe, VGK. Those have all held those key 2018 highs. So has EMXC. Can't say that about EEM. So while EEM is showing leadership beneath the surface, at the index level, it's actually the weakest. So you want to be very careful to not express that bullish EEM thesis through the EEM ETF right now. Until China bottoms out, that's going to remain the case.
All right, Steve, the last thing I want to get your thoughts on are precious metals. We're finally seeing gold catch a bid and gold mining stocks outperform the S&P 500 a bit. Here's a chart of gold futures, the weekly chart. You can see to the right that we're breaking out of that triangle consolidation pattern that we've been kind of coiling up in for the last year or so. Here's a more zoomed in version of that, and we're finally above 1900, about 6-month highs, so that's constructive. When you see this bid in gold, do you see it as a flight to safety, or is this more of the commodities theme that we've been talking about for weeks now?
Oh, you took the words right out of my mouth. This is not a flight to safety. So if this was defensive positioning, right, then you would see treasury bonds and yen catching a bid also. They're not. They're continuing to just collapse. Actually, they look terrible. Gold is catching a bid, but that's more the commodity theme, like you said. Commodities are firing on all cylinders. It's been that way for a long time now. Precious metals have not been participating for about 18 months now, since summer of 2020. So it makes a lot of sense, in the context of what's going on with the rest of commodities, that gold and silver would finally start participating. I think that there's more time for this trade. I think the better entry is once we actually make new highs. There's still a lot of overhead supply to kind of work through, but you're right about the relative trends. If you look at SPY GLD or even, the miners on a relative basis, there's some nice reversal patterns kind of shaping up there that are worth paying attention.
I mean, here we have 6-month highs in GDX. Is that something, are you looking for opportunities within the metal space? Are you looking to take trades within gold miners right now, or what do you kind of think? Do you think it needs more time? Because you said, you're looking at those 2020 highs to get real build up, right?
Yeah, I'm not really interested yet. I think there are far easier trades, and especially like far easier trades even within the commodity space. So even when you look at material stocks, industrial stocks, agricultural inputs, there's a lot that's working. There's a lot of charts that are breaking out of nice bases above their 2018 highs, clean levels, clean charts, clear uptrends. I would rather be hanging out in those names than in precious metals right now. I think that if and when, because you look at the structural trend here, this is a nice big base. When it finally does make a, decisive upside resolution, take out those 2020 highs, I think there will be plenty of time to get long and make money in the precious metal space. I just think probably want to be patient here, and there's plenty of other opportunities elsewhere. So,
yeah, and you're kind of echoing similar sentiment to what I've heard other technicians talking about. It's kind of like, wake me up when we break out of those 2020 highs. Until then, it might just break more hearts like it has been doing for the past couple of years, right?
It's still in range there. It's still got to work through, the price memory from the last 2 years.
Yeah, I mean, it's getting there, and I think we've made some good improvements in the last couple of weeks, so that's notable, I guess.
6 months.
Anyway, is there any?
Are a big deal. Yeah, totally.
So what stock did you bring? What do you like?
This is Grin Rod Shipping.
Grin Rod Shipping. What is that? I've never heard of that one.
I hadn't either until recently. So this is a small cap Singapore-based shipping stock. It's about $500 million market cap. Shippers have been really hot for a while now. This is a beautiful chart. I also love the wordplay with the symbol. It's ticker symbol GRIN. We always joke that we like to buy smiley faces. This is exactly that, a nice big grin on this chart. So what that means is a big base, call it a cup and handle, call it whatever you want to call it, but we just resolved higher. And like I said, it's in the right space. It's a strong stock. You got a clean level there to trade against. It also pays a 3.5% yield. So there's a lot to like with this chart. Also, from an educational standpoint, this one is a great case study. It just had earnings today. I was tweeting about it yesterday before it had resolved higher. And this is what stocks look like when they're about to beat earnings. You see it all the time where there's just a bullish pattern that's about to trigger an entry, right near a breakout level, pressing against the upper bounds like this one was. And it just needs that earnings report to kind of kick off that fresh leg higher. And that's exactly what we saw. We're up 20% today.
Nice. So earnings are in the rearview mirror. They're behind us. You don't have to worry about it, right?
Absolutely. Which is another thing that we like. So
now, does that include the post earnings action? So
yeah, it does.
Okay.
Today.
Nice. All right. Well, Steve, thank you so much for coming on and sharing your charts with us. We look forward to talking to you next week.
Thanks for having me. Talk to you then.
As always, this is for educational purposes only, and nothing we say here is meant to be taken as investment advice. If you enjoyed our video, be sure to subscribe, and we'll see you next week. Thank you.